Hi, my name is Elliot Gu. I'm co-founder and chief market strategist for the Pig vs. Bear trading service. Today I want to tell you about a technique. It's a sort of trading pattern, if you will, that we've used to identify profitable trades in Pig vs. Bear over the past few years. In fact, it's a technique we recently used to identify what we believe will be a very profitable, bullish trade in the market for gold. I created this video presentation to explain exactly how this trade works, how to use it to identify profitable swing trading opportunities in many different markets, and exactly how we're trading the gold market right now. I've been using this simple technique for years, and while you might find it counterintuitive at first, I believe you'll be able to use it to make some serious cash, regardless of whether the stock market or commodity markets are headed up or down. But before I go any further, I want to say this. Look, I know the word trading scares a lot of people. It probably conjures up the image of someone sitting in front of their computer all day, trying to scalp a few pennies trading stocks or commodities. After all, you may consider yourself to be a long-term investor or an income-focused investor, and you may think that means that trading is too risky or it's just not for you. However, the techniques I'm going to explain today have nothing to do with day trading. These techniques, which we do utilize extensively in the Pig vs. Bear service, are aimed at identifying profitable stock, exchange-traded fund, ETF, and options trades over holding periods of several days out to several weeks or longer. In fact, some of our best and most successful trade recommendations over the past few years have been trends that we've ridden for several months. You do not have to sit in front of a computer or your PC all day. In fact, you can trade like this in many cases while only logging onto your online brokerage account just a few times a week. And let me also assure you that you don't need a futures trading account to make the trades in gold I'm going to outline in this presentation today. As I'll show you in a moment, you can use an exchange-traded fund, or ETF, that you can purchase from just about any online brokerage account to play this move. Finally, let me assure you that I consider myself to be primarily a long-term investor as well. I still think that you'll find these trading techniques and strategies to be a useful addition to your toolbox. However, I must warn you that at this late stage of the economic and market cycle, as market volatility picks up, buy, hold, and forget and passive indexing strategies, and these are the strategies that really worked in last year's low volatility, correctionless bull market. These same strategies that worked so well last year can really cost you some serious cash. In contrast, trading strategies thrive. Trading strategies such as the one I'll explain here in just a minute often do their best in these late cycle, high volatility markets. So the key to this trading technique is something that an experienced floor trader in the commodity markets told me close to 20 years ago. Okay, so he told me, you must understand that a market's reaction to news is often far more important than the news itself. So in a bull market, good fundamental news for a stock or commodity will usually result in a significant rally for that stock or the commodity. That's normal and should be expected, nothing unusual there. However, and this is what's really important, in a bull market, investors and traders will often buy any dips caused by bad news. So for example, you might see a stock open 3% lower after reporting weak earnings numbers. And then that stock will end up closing higher on the day because investors bought the dip. This pattern is pure gold because it tells you that there's underlying strength in the stock. In contrast, in a bear market, all news is basically bad news. Typically, if there's good news coming out on a stock or commodity, you'll see that stock or commodity open higher, pop intraday, but investors will use any strength as an opportunity to sell. So here's what I like to look for. I like to look for situations where stocks or commodities rally in response to quote-unquote bad news. So these are markets you want to look to buy. Alternatively, I like to look to short stocks to bet on a decline in stocks or commodities that sell off following good news. This pattern suggests underlying weakness in the market. So let me explain how this pertains to the gold market right now. The first thing you must understand is that historically gold prices, so that's the price of gold in dollars per ounce, and interest rates are negatively correlated. So that's a fancy way of saying that typically gold prices rise when interest rates fall. And conversely, gold prices usually fall when interest rates rise. So look at my chart here. To create this chart, I simply plotted the monthly close in the price of gold against the monthly yield on 5-year Treasury inflation-protected securities, or TIPS. And I used data over the last 20 years. So TIPS are nothing more than a U.S. government bond that's adjusted to compensate the investor for inflation. The yield on these TIPS represents the real yield an investor gets from these bonds after being compensated for inflation. So each of these dots represents a single monthly observation of the yield on 5-year TIPS and the price of gold. And I've drawn a trend line here to show you the relationship more clearly. As you can see, when real yields rise, when the yield on these Treasury inflation-protected securities rises, this tends to be bearish for gold. And when the yield on TIPS is low, this tends to be bullish for gold. This R-squared value of 77% tells us it's a pretty tight relationship. R-squared is a statistical measure that ranges between 0 and 100%, where 100% represents a perfect fit of the trend line to the data, and 0% suggests no fit at all. It's very rare in financial markets to find an R-squared value this high. And in fact, this analysis that I'm presenting to you is nothing new. There have been several academic research papers, including a paper out of the Fed, that are out there documenting the negative relationship between gold prices and interest rates going back a lot further than just the last 20 years. Of course, I think it was Mark Twain who once quipped that there are 3 kinds of lies. There's lies, damn lies, and statistics. So rather than just looking at the numbers like this, I like to think of the why. Why is there a negative correlation between gold prices and interest rates? Well, fortunately, there's also a valid logical why. There's a valid logical reason for gold to perform poorly when rates rise. Okay, so just consider that you could hold your wealth in a currency like the US dollar or the euro or the yen, or you could purchase gold bullion or an ETF that owns gold as a store of your wealth. If you hold your wealth in dollars, you can earn interest by putting those dollars into a savings account or investing in a risk-free security like a short-term US government bond or even a high-quality corporate bond. Holding gold, in contrast, pays no interest. In fact, holding gold may actually entail some costs to store the bullion. So even if you own gold in an ETF, like the popular SPDR gold shares that trade under the symbol GLD, you're still paying storage costs because these costs are loaded into the expenses of the ETF. That gives rise to what we call an opportunity cost for owning gold. When interest rates are ultra low or negative, that's not much of a cost because holding US dollars doesn't pay much interest anyway. However, as rates rise, it makes holding dollars more attractive because you can earn that higher return on those balances. You can earn that interest rather than having to pay storage costs to own gold instead. Okay, so that brings me to this. The Federal Reserve hiked rates on December 13th, 2017 at the end of last year, and again on March 21st of this year. There have also been some serious concerns over the last few months that strong U.S. economic growth, some early signs of inflation might force the Fed to hike more aggressively in 2018 and 2019. So look at this chart. As you can see, the yield on 5-year TIPS shot up from under 30 basis points, that's 0.3%, in mid-December of last year, to around 54 basis points in early March this year. So normally you'd expect the price of gold to fall when rates rise that sharply, but that's just not happening. Let me overlay the price of gold here, and you can see that gold prices are actually up around 7.5% since their December lows, even as those 5-year tip yields have nearly doubled over a similar time frame. So what would normally be bad news for gold is acting like good news. This suggests underlying strength in the gold market and an opportunity to trade gold on the long side, betting on higher prices. Okay, so let me back up and show you the pattern for gold over the past 18 months or so around Fed meetings when the central bank has hiked rates. These are called live Fed meetings. This pattern can help you time your entries and trades on gold, and it's something I explained to Pig versus Bear readers just ahead of the Fed's March 21st meeting. So let's look at the Fed's last 4 live meetings. These are meetings, again, where the Fed hiked rates in each case by 25 basis points. So let's start with December 14th of 2016. The Fed increased the benchmark interest rate by 25 basis points to a range of between 0.5 and 0.75%. So gold prices tumbled from more than $1,300 an ounce in early November of 2016 to around $1,150 an ounce on December 14th. So about a $150 an ounce decline, sell-off in gold, ahead of the Fed meeting on December 14th. The precious metal then hit an intraday low of $11.21 an ounce on December 16th before rallying about 13%, as you can see, by late February of 2017. Fast forward to March 15th, 2017. The Fed announced another 25 basis point rate increase. In roughly 2 weeks leading up to the central bank's meeting, gold gave up 5.5% of its value, bottoming out around $1,200 an ounce. But on the day the Fed unveiled the rate increase, actually announced it, gold prices soared. And through the end of April last year, the precious metal gained about 8%. Now let's go to June of last year of 2017. June 14th of 2017, the Fed again hiked interest rates by another 25 basis points, 0.25%. Gold prices slid about 4% over the next 2 weeks, so this is a little different pattern. But they bottomed out in early July and climbed to $1,350 an ounce between early July and early September. All told, the precious metal gained about 12% from its early July low and about 8% from its closing price on the day the Fed hiked rates, June 14th. Now let's fast forward to the end of last year. On December 13th of 2017, the Fed hiked interest rates by 25 basis points yet again. Gold prices retrenched sharply from early September up until December 12th, the day before the Fed meeting. But then, look here, they surged after the central bank's meeting. By late January of 2018 of this year, the precious metal had gained about 10%. So do you see how gold prices have been acting in, let's call it, an unexpected way to the last 4 Fed rate hikes? Rate hikes have actually marked a bullish turning point for gold. These hikes have tended to lead to rallies in the range of 8 to 10% over just a few weeks following the Fed meeting. Well, the gold market seems to be following the same script around the Fed's most recent rate hike on March 21st. Gold sold off from around $1,366 an ounce in late January of this year to around $1,310 an ounce on March 20th, the day before the Fed meeting. It then rallied sharply on the news of the actual Fed rate hike on March 21st. And if history is any guide, we expect about an 8 to 10% move, and we think gold can jump up here to the $1,425 to $1,450 an ounce range over the next month or two. So you might be wondering, how can I trade this move? And I must caution you, I don't know when you're watching this. So you have to be careful about your entry points. But that's what we're looking for in the price of gold. If you want to know how to trade this move, the good news is that it's actually pretty simple to trade gold through your normal online brokerage account these days, as I mentioned earlier. In our Pig versus Bear trading service, we've been recommending the ProShares Ultra Gold ETF, which trades under the symbol UGL. So this ETF is designed to rise in value by 2% for every 1% rise in the price of gold. So it gives you leverage exposure to the gold market. And since gold is sitting here on a key technical support level, we can set a fairly tight stop loss on this trade just in case we're wrong about gold and it breaks the trading pattern I just showed you that we've seen over Fed rate hike events over the last 18 months or so. Now, if you like to trade options, an alternative would be to buy call options on the popular and very liquid Spider Gold Trust, which trades under the symbol GLD. This can give you even more upside leverage to the price of gold than the ETF I just mentioned. However, again, you have to be very careful trading options in terms of selecting the strike price of the option that you buy and the expiration month. In short, if you understand how to trade the news and how bad news can actually be bullish, I think you can use this simple technique to make some money trading markets like gold, particularly as overall stock market volatility picks up this year. Watch your inbox because in an upcoming video I'll send to you, I'll give you a quick primer on how options work, a few tips for how to select the correct options contracts to buy or sell, and a simple yet powerful rolling up option strategy we've used to profitably play trends in several stock market sectors over the past 3 months. And I'll show you how we're using this strategy in Pig versus Bear to play these intermediate term trends while actually lowering our overall risk. Thank you very much for listening to me today.